Welcome back to BizIntel, our weekly bulletin that helps us go beyond the headlines to truly understand the underlying forces reshaping the global economy and technology landscape. If there were one word to describe the past week, it would be limits. We saw the physical limits of electricity threatening the AI boom, geopolitical limits redrawing the global supply chain map, and limits of trust putting financial markets to the test. From Ford being forced to step back in the face of Chinese battery technology, to the USD 10 billion power hunger of data centers, to the quiet confrontation between Wall Street banks and the crypto world, BizIntel will connect these stories to show one core truth. In a volatile world, one player's risk is another's opportunity. This week's coverage revolves around four key pillars that have been shaking the world: the AI race and its infrastructure constraints, the shifting dynamics of electric vehicles and defense, the evolving landscape of finance and crypto, and finally, major developments in the social and political sphere. The AI thirst and the battle of capital-intensive infrastructure. This week opened with the overarching story of the moment: a brutal collision between AI ambition and hard physical limits. As 2025 draws to a close, a stark reality has become impossible for the tech world to ignore. AI is no longer an abstract realm of elegant code or invisible data clouds. It has revealed itself as a very real physical beast, demanding land, concrete, and energy on a scale never seen before. Looking at the energy picture, a troubling paradox is confronting policymakers. While net zero commitments are championed worldwide, AI's surging demand for electricity has reached an alarm threshold, threatening to undo hard-won environmental progress. Planning data shows that new data center projects alone will require as much as 128 gigawatts of power, enough to supply several mid-sized countries. The gap between expectation and reality is widening fast. At the application layer, success stories like the coding assistant Cursor, boasting billion-dollar revenues, create the impression of an unstoppable boom. But at the infrastructure layer, the pace of grid expansion and power plant construction is still crawling. Aging physical infrastructure simply cannot keep up with the rocket-speed expectations of software innovation, creating a dangerous bottleneck for the entire sector. To solve this existential problem, smart venture capital is executing a dramatic pivot. Anjane Midha, a former high-profile partner at a 16Z, is raising USD 10 billion for the AMP consortium with a singular goal: building power plants. This marks a game-changing shift. Investment logic is moving away from backing the smartest AI models toward owning the infrastructure every model depends on. The message is brutally clear. In the AI era, those who control the power sockets hold the real power, not those who write the best algorithms. The electricity crunch has grown so severe that it has spilled beyond business into the political arena. The White House is pushing to wrest control of the power grid from individual states, a rare move that risks triggering legal battles over federal versus state authority. Washington now frames AI as an urgent national security issue, justifying priority access to energy. But the cost may fall on ordinary citizens, as fears mount that household electricity bills could rise sharply to subsidize cheap power for data centers, raising serious questions about social equity. Yet amid the infrastructure investment frenzy, the specter of a massive bubble is beginning to loom. While hundreds of billions of dollars are pouring into hardware, power, land, chips, cracks are emerging on the software side, where profits are supposed to justify those investments. Consider OpenAI's ambitious target of USD 200 billion in annual revenue by 2030, a figure that remains far removed from current reality. The uncomfortable question facing financiers is this: if trillion-dollar data cities are built but AI software fails to deliver sustainable business models, will they become nothing more than abandoned technological ruins? Speaking of survival, OpenAI itself is making what may be its ultimate gamble, raising USD 100 billion at a staggering valuation of USD 750 billion. These extraordinary numbers effectively place OpenAI in the category of too big to fail. By drawing capital from a mixed roster of tech rivals such as Microsoft and Nvidia alongside Middle Eastern sovereign wealth funds, OpenAI is binding its fate not just to the tech industry, but to global geopolitics. On the other side of the globe, ByteDance, the parent company of TikTok, has unveiled plans to spend $23 billion on infrastructure next year, with half earmarked for acquiring AI chips at almost any cost. Why this sense of urgency, bordering on panic? The answer lies in an implicit ultimatum from Washington. New U.S. tariffs and chip control policies will take full effect by mid-2027, following an 18-month grace period. This is not leniency, but a countdown clock forcing companies to sever supply chain ties with China. ByteDance and other giants are racing against time to stockpile enough chips before the technological border slams shut for good. Against this backdrop, NVIDIA, the crownless king of the chip world, has made a calculated move, spending $20 billion to acquire Grok, a startup specializing in inference chips. The deal reveals Jensen Huang's long-term vision. He sees a future in which customers can no longer afford to endlessly chase expensive H100 chips for training. Demand will shift toward cheaper, faster chips optimized for real-world applications. Acquiring Grok allows NVIDIA to neutralize a potential rival early while diversifying its portfolio to maintain dominance in the era of affordable AI. In stark contrast to NVIDIA's power stands the decline of an old icon, Intel. Intel's fragility was laid bare when a single tentative decision by NVIDIA to pause testing of Intel's 18A process was enough to send Intel's stock reeling. The episode delivered a harsh verdict. True authority in the semiconductor industry now rests firmly with NVIDIA. A deeper look into Silicon Valley reveals an increasingly dangerous web of relationships, frenemies entangled with one another. Google competes with Apple while selling TPU chips to rivals. OpenAI relies on NVIDIA chips but runs them on Microsoft's cloud. This mutual dependence creates enormous systemic risk. It is like a circular domino setup. If a critical link such as TSMC or NVIDIA were to fail, the entire Silicon Valley ecosystem would shudder. Finally, no picture of AI power dynamics would be complete without Elon Musk. Grok, Musk's rebellious chatbot, is now being tested by the U.S. military. The Pentagon is drawn to the advantage of real-time data from the X platform, yet this is a culturally risky marriage. Can Musk's wild, loosely controlled style coexist with the iron discipline of the military? That is a question 2026 will have to answer. When AI grows up and the enterprise equation, leaving behind the tangled world of land, concrete, and power lines, we move up the stack to the software application layer, where a painful but necessary transformation is underway. The past week offered the clearest evidence yet that AI is moving beyond casual chatting and into a phase where it must go to work and generate real revenue. Setting the tone was ClickUp's acquisition of Cogen. The deal signals that management platforms have identified a fatal weakness of chatbots: their lack of context. By buying Cogen, ClickUp aims to turn AI assistants from strangers into colleagues who understand internal data. This is a concrete effort to turn AI from a tech novelty into a profit-generating tool, marking the shift from excitement to operational effectiveness. But running AI at the enterprise level introduces a new fear: accountability. When AI says the wrong thing, the legal consequences can be severe. That is why Snowflake spent $1 billion to acquire Observe Inc. to strengthen system monitoring. The message is unambiguous. For CTOs, control is now as important as intelligence. Companies are willing to pay a premium for peace of mind, turning system safety into a new gold mine. Along the same defensive logic, ServiceNow accepted the risk of short-term punishment from Wall Street by spending nearly $8 billion to acquire cybersecurity firm Armis. CEO Bill McDermott is betting on a long-term vision. In an era of IoT and AI, the cyber attack surface is expanding without limit. Security is no longer an add-on feature, it is a condition for survival. The company is sacrificing near-term returns to buy a shield for the future. For everyday users, the free honeymoon is nearing its end. OpenAI is preparing to introduce advertising into ChatGPT, seeking to monetize its base of 900 million users. It is a pragmatic move, but a double-edged sword. When answers are accompanied by sponsored suggestions, trust in objectivity. ChatGPT's most valuable asset will be put to the test. Users will inevitably ask, is this answer the truth or the result of paid placement? Strategic divergence is also splitting Silicon Valley. While OpenAI struggles to balance an academic research culture with mounting commercial pressure, rival Anthropic is advancing quietly with a more pragmatic approach, focusing on APIs for developers. Anthropic is demonstrating that the ultimate winner may not be the company with the smartest model, but the one that packages its product in the most sellable way. In China, the picture is far harsher. Two unicorns, Minimax and Jipu, are rushing to list in Hong Kong despite heavy losses. Unlike their US counterparts, Chinese startups are trapped in a strategic deadlock. Going public now is an act of burning cash to buy survival, a way to stay afloat before funding runs out. It is a high-risk gamble where collapse may arrive faster than success. Perhaps the most intriguing development comes from a sociological angle. Beijing has drafted regulations to ban AI systems that simulate love or encourage emotional dependence. The move reflects striking clarity. While the West debates data copyright, China is concerned about the erosion of social structures as young people immerse themselves in virtual relationships. The psychological impact of technology is being treated as a matter of social security. Aware of these risks, AI leaders have quietly changed their reading habits, from technical manuals to political history and the art of governance. They understand that the next barrier is no longer algorithms, but the ability to navigate power. They are no longer just engineers. They are being forced to become reluctant politicians in the digital age. Electric vehicles, batteries, and the defense realignment. Leaving the virtual world of software behind, we step into the realm of heavy industrial manufacturing, where physical constraints and geopolitics are forcing historic strategic reversals. The most jarring story of the week came from Detroit, the heart of America's auto industry. Ford, a more than 100-year symbol of U.S. industrial pride, was compelled to make a painful decision, suspending production of the F-150 Lightning electric pickup and turning to battery technology from China's cattle. Ford's decision to halt its production line and acknowledge the need for technology from its largest geopolitical rival is a technological concession, but a remarkably sober and pragmatic financial move. The company has confronted a reality many Western policymakers prefer to avoid. The current U.S. domestic battery supply chain is simply not efficient enough nor cheap enough to compete head-to-head. Ford's pivot toward ERV technology, electric vehicles with gasoline range extenders, and its cooperation with China underscore a hard truth. In a corporate survival battle, profits and cash flow always prevail. While hardware manufacturing struggles, the dream of autonomous vehicle software has just endured a real-world nightmare in San Francisco. A widespread power outage turned some of Waymo's most advanced robo-taxis into useless metal boxes, snarling traffic across the city. The incident exposed a critical weakness of AI: social adaptability. When traffic lights go dark, humans drive using an unwritten but sophisticated law of the street. A wave of the hand, eye contact with a traffic officer, or a tacit act of courtesy. AI cannot read these social cues. It is programmed to follow rules, and when the rules themselves disappear, it freezes. The Waymo episode is a sobering reminder. Technology may be 99% ready, but the remaining 1%, handling the chaos of the real world, remains a long and treacherous road ahead. No discussion of autonomous vehicles would be complete without Elon Musk and Tesla. In 2025, missed deadlines continue to define the story. While Tesla's stock has remained resilient, its momentum is driven almost entirely by promises of a future, robotaxi, Optimus, rather than present-day performance. In reality, Tesla is facing a second consecutive year of declining vehicle deliveries. And while Waymo is already operating in the real world, despite setbacks, Tesla's offerings largely remain confined to presentation slides. Investor patience is not infinite. The market is beginning to ask a sharper question. Is Tesla's trillion-dollar valuation the mark of visionary genius ahead of its time, or the product of a powerful marketing machine masking delays in execution? Yet, the most consequential and unsettling trend in energy this week is not unfolding on city streets, but over future battlefields. We are witnessing a quiet but massive migration. Battery technology startups, battered and unprofitable in the brutally competitive consumer EV market, are finding a wealthier savior, the military. Companies such as SES AI and Factorial Energy are redirecting research from household vehicle batteries to power sources for combat drones, missiles, and military hardware. The reason is straightforward. The EV market is a race to the bottom on price, with razor-thin margins. By contrast, the Pentagon is willing to pay a premium for maximum performance and absolute safety. America's vast defense budget has become the industry's life support system, keeping domestic battery innovation alive. But the implication is stark. Technologies once conceived to green the planet are now being nurtured for destructive ends. All these threads lead to an unavoidable conclusion. Technology has officially become a weapon. The era of technological neutrality is over. From U.S. bans on Chinese drones to competition over deep-sea mineral rights to the regulation of every line of autonomous driving code, business decisions are now inseparable from national security calculations. Companies are no longer competing solely on the quality of their products. They are competing on the strength of their passports. A technological iron curtain is descending, and in this new world order, the line between a technology company and a defense contractor is rapidly disappearing. Finance, crypto, and high-stakes bets. Finally, let us follow the money, the place where reality is revealed most clearly. We begin with the U.S. stock market, the global financial system's guiding beacon. At first glance, an 18% rise in the S&P 500 paints a picture of a thriving economy. But peel back that glossy surface and a troubling truth emerges. The market structure is dangerously imbalanced. Nearly all of the gain are driven by the Magnificent Seven, tech giants such as Nvidia, Microsoft, and Apple. Together, they account for roughly 36% of total market capitalization and generate the bulk of profits. In effect, the entire U.S. economy, and by extension, pension funds around the world, is betting its future on a single engine. This level of risk concentration is unprecedented. It creates a knife-edge scenario. If Nvidia so much as sneezes, global financial markets could fall like dominoes, because the rest of the market is, in reality, alarmingly fragile. That fragility is most visible in the IPO market. Beyond the glow of the Magnificent Seven, the listing landscape is bleak. Over the past year, most newly listed tech companies have crashed on landing, with shares trading below their IPO prices. High-profile names such as Navan and StubHub have struggled to gain traction. The message from investors is blunt. They are exhausted by being left to clean up the mess of inflated private market valuations. The era of growth at any cost is over. Capital now flows only to businesses with real, demonstrable profits. If all you are selling is a dream of future revenue, Wall Street will slam the door in your face. The liquidity drought is not confined to public markets. It has crept into the most private corners of high finance. A rare and unsettling phenomenon is unfolding. Giant private equity firms are running short of cash. Unable to exit portfolio companies in today's market, they are being forced to sell stakes in their own management companies to raise liquidity. It is akin to a farmer selling his tools just to buy food for the day. This reveals that Wall Street's legendary money-making machine is malfunctioning far more seriously than glossy financial reports suggest. A silent liquidity crisis is taking shape beneath the surface. Turning to crypto, 2025 resembles a sleek Ferrari with no fuel in the tank. Despite decisive legal victories over the SEC and new stablecoin legislation promising a brighter future, the industry remains stuck. The core problem is simple. Stablecoins cannot find banks. To function, crypto firms need banks to hold reserves and convert assets into US dollars. Yet, traditional banks, constrained by compliance and risk controls, are refusing to engage. Crypto can move across borders in seconds, but to touch real dollars, it still must pass through the aging pipes controlled by Wall Street's gatekeepers. Last week's decision by JP Morgan to freeze accounts belonging to payment startups such as BlindPay and Contigo was a brutal wake-up call for dreams of financial freedom. It reaffirmed a hard truth. No matter how advanced your blockchain technology may be, ultimate power still lies with the guardians of the banking system. Crypto seeks to replace banks, yet paradoxically survives by depending on the very system it wants to dismantle. And when the host, the bank, grows uncomfortable, a single flick of the wrist is enough to cut these startups off from oxygen. Finally, a small but deeply symbolic story underscores the limits of technology. Even Elon Musk, the world's richest man, builder of the most powerful XAI supercomputer, must learn the art of local compromise. In Memphis, residents have protested the deafening noise from generators at an XAI site. To ease tensions, Musk has had to fund the city's Christmas Light Festival. The episode offers a simple lesson. You may command extraordinary artificial intelligence, you may dream of Mars, but your feet still stand on the ground. No matter how powerful it becomes, technology cannot be separated from community and social responsibility. Sometimes, winning the approval of your neighbors matters more than writing the most sophisticated lines of code. Reality check. How tech's next chapter will be written. Taken together, these stories are not isolated headlines. They reveal three powerful undercurrents now shaping the path into 2026. Consider OpenAI's USD 100 billion figure and AMP's USD 10 billion fund. These numbers signal a pause in the era of software eats the world. We are entering a phase where hardware captures the profits. For more than a decade, Silicon Valley taught us to invest in what was light, scalable, and intangible: apps, platforms, the cloud. This week, that message flipped. AI cannot live in the cloud without electricity on the ground. The result is a massive reallocation of capital. Venture investors are no longer hunting for coders in garages. They are hunting for power plant permits, land, and chips. Ford's decision to step back in the face of Chinese battery technology is not just the story of one automaker. It is a wake-up call for the West. For years, the United States and Europe believed they could use money and policy to rapidly build independent battery supply chains. But Ford's handshake with KTL combined with US. Battery startups pivoting toward military contracts just to survive exposes a harsh reality. China is ahead in this race. The 2027 chip tariffs and the 18-month deadline are attempts to reverse the momentum. Yet, look closely. Ford, a symbol of American industrial pride, is willing to rely on a geopolitical rival's technology to protect its cash flow. Finally, why did NVIDIA buy Grok? Why is OpenAI introducing advertising? Why did ClickUp acquire Codagen? All roads lead to one conclusion: AI must generate revenue. The era of burning cash to buy growth is over. Failed IPOs and the desperate public listings of Chinese AI startups are proof the market no longer pays for intelligence alone. It pays for efficiency. Nvidia bought Grok because it knows customers are running out of money for premium chips. OpenAI is turning to advertising because a vast free user base does not pay the bills. B2B software companies are acquiring smaller AI startups to embed intelligence directly into real workflows. This past week made one thing clear: the tech world is no longer a pastel playground of futuristic dreams. It has become harsher, more pragmatic, and more unforgiving. Ford chose to step back technologically to move forward financially. Nvidia chose to absorb a rival's technology to secure its throne. And figures like Elon Musk and Sam Altman are learning to negotiate with the constraints of the real world, from neighbors in Memphis to the limits of national power grids. The central lesson of the week is adaptation. In this storm of change, survival belongs not to the strongest, but to those who face reality most honestly and adjust their sails in time.